You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody, that music means it's time for TWIFO, This Week in Futures Options, the final program of our broadcast week here on the old network, the show that wraps it all up in a nice little bow. Looking back at the week that was, and in some cases still is, over there on the futures options side of the fence. Maybe a little bit of energy, a little bit of gold, a little bit of indices, a little bit of lean hogs. You never know what's going to make it onto the show. Going to break down the volatility, the skew, the open interest, the unusual activity, all that fun stuff, and a lot more here on TWIFO. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the aforementioned network. You guys know how to get us by now. iTunes, TuneIn, Stitcher, so on and so forth via our website, as well as the CME Group website as well. And, of course, you can always join us live every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern, via Mixlr, MIXLR. Grab that link, set it and forget it. And you, too, can enjoy the futures options goodness that is TWIFO. However, you listen live after the fact via our app, via wherever you get the show, make sure you hit us up. Questions, comments, insights, pearls of wisdom. You guys have a lot of questions lately asking us to do your homework for you. Scan in, doing this, doing that. We'll see if we can get to some of those. But all sorts of many and varied questions. We love them. Keep them coming, even the ones that make Nick do some homework. Speaking of Mr. Nick, let's bring him on. I am joined by my cohort, my partner in crime, the founder of Bantix Technologies, creator of a little platform we like to use around here at least once or twice called Quick Strike. Mr. Nick, welcome back to TWIFO, sir.
Hey, I'm out here in a remote location, so hopefully it's not too awful with the ambient noise behind it. But since you sound like the DJ from the old movie Car Wash, that's how I'm hearing you anyway. So my sound can't be much worse than what I'm hearing. So hope it goes well today from my currently undisclosed location.
You and your undisclosed bunkers around the world. Well, it's not as crystal clear as we're used to from you in the Bantix HQ, but I think we'll make do. I guess it depends on the quality of our next guest and also our next caller. That is our old friend of the show. He hasn't been on in a little while, so we're happy to have him back on because when he comes, he always comes armed with all sorts of great data and research on the product you guys love to trade. He is Eric Norland, the senior economist over there at CME Group. Eric, welcome back to TWIFO, sir.
Thank you so much for having me back. It's great to be here.
Joining us all the way from London. That's how much he loves you guys. He should be home relaxing. The work week is over there in London. Nope, he's dialing into TWIFO to educate you folks on all things futures, options. And actually, he's got a lot of interesting and late-breaking research, so it's good timing to have you on the show now, Eric, because you put out a lot of research papers just in the last week or so let's get to them. Let's start off in an area, a product category Nick and I like to talk about quite a bit. These are, of course, the shiny stuff, the metals. It's been an interesting area to watch of late. Of course, gold has an interesting, shall we say, relationship to the broad market. And when we're seeing things going on of late, like, of course, new Fed regime coming in, like the Treasury Secretary maybe talking down the dollar a bit, like the market selling off and then rebounding. All these things have interesting interplays and relationships with gold, not to mention what's going on with the skew and the volatility and all sorts of fun stuff. So let's start there, Eric. Your latest paper is called Gold Showing Strength Despite Rate Hike Signals. A lot of interesting takeaways from this one. What were some of the interesting nuggets you found in your research here on gold, Eric?
So one of the things that really drives gold prices, in fact, what correlates more strongly with gold than any other asset that trades at CME Group is the Fed funds future. Now, bear in mind, not the Fed funds future 1 month in advance, but the Fed funds future more like 1-2 years out. So some of those back contracts usually have a very strongly negative correlation with gold when you view the future from an interest rate perspective and not from a price perspective. So what I mean by that is when Fed funds futures start expecting more rate hikes than they had expected previously, that's usually really, really bad news for gold. It's usually enough to send gold into a tailspin. And what we've seen over the last couple of months, I think, is so fascinating and so unexpected, is that correlation is now breaking down for the first time in many, many years. And we've seen this huge increase in expectations for what the Fed is going to accomplish. The Fed has been telling us for a long time that they're going to raise rates 3 times this year, 3 times next year. And up until early December, nobody in the market really seemed to believe them. The market 3 months ago was pricing 1 rate hike this year and 1 rate hike next year. And so now the market's gone to pricing 3 to 4 rate hikes this year and maybe 2 or 3 more next year. It's just an enormous change. Normally that should have been terrible news for gold, but gold prices are actually trading a bit higher now than they were a few months ago. The market has completely resisted this move towards tighter Fed policy. And so what that suggests to me is if we get some sort of correction in Fed funds futures, the Fed funds futures rally in price and sort of fall in interest rate expectations, then we could see an explosive upside move in gold.
By the way, listeners, you guys, I forgot to mention at the top of the show, you guys can always follow along with the show, cmegroup.com/TWIFO. That's where you can actually generate a lot of the live options charts and data and tables that we use at QuickStrike. Throughout the show, you can, of course, also read along with Eric's research, clicking on the research tab over there, and you can find his latest breakdown on gold. You know, I encourage you to read it if you can. Listening to it is always fun, listeners, but there's a lot of great charts and visuals in here that really break down interesting stuff. You know, Eric, one of the things that caught my eye in your report, something that Nick and I have been talking about quite a bit here on the TWIFO program here, is just how anemic gold volatility is. In fact, as I recall, I think your first appearance on this network was to a very aptly titled and well-timed report a few years back called Gold Volatility Storm on the Horizon, because the gold volatility was quite low. We're reaching some pretty impressive lows now as well, Eric. Is it time for a part two to that paper? Is the gold storm number 2 on the horizon for us here from a volatility perspective?
Well, you know, it's hard to say. Volatility is pretty low across all of our markets. I mean, we have the VIX now back up to around 19-20%. But even that's pretty low by historical standards. Just seems high by the standards of recent history. But you're absolutely right there. Gold implied volatility at the money today is trading at below 12%, and it almost never gets below 10%. So it's very, very cheap right now. And so I look at all of these numbers with concern that we are going to be moving out of this very low vol environment into a potentially much, much higher volatility environment. And, recent fiscal developments in the U.S., I think explain in part why the markets are perceiving so much upside risk to gold. When we hit bottom in that recession back in 2008 and 2009, which of course we know that whole period was really good for gold, we had budget deficits of 10% of GDP, which is just mind-boggling. Over the course of the next 8 years, through sequesters and tax hikes and letting tax cuts expire, we got that deficit down to just 2.5% of GDP. But even before the tax cut happened, that deficit was already creeping down to 3.5% of GDP. And now with the tax cut and with this incredible spending legislation that got through Congress and was signed earlier this month, huge increases in military spending, big increases in domestic spending, and this is before we do anything with infrastructure or a wall between the U.S. and Mexico, et cetera. We're looking at budget deficits of 5 or 6% of GDP. So one of the other mysteries in the markets right now isn't just why is it gold prices are resisting this rise in Fed funds futures? Is why is the dollar not rising as the Fed hikes rates? Normally it should be bullish for the dollar. And the answer is very simple. The U.S. fiscal situation is deteriorating very, very rapidly. That's causing weakness in the dollar. It's supporting gold in spite of expectations that the Fed is going to do a lot of interest rate hiking. And as the Fed hikes interest rates more and more, they are going to bring the yield curve to a flatter and flatter position. And once the yield curve gets pretty flat, the chances are that within the next 12 months after that, or maybe the next 24 months, we are going to see a cataclysmic explosion in volatility across markets. So it will hit gold and silver, obviously, but it will also hit bonds, equities, currencies, all sorts of other assets. And it will bring us out of this low volatility state into a much, much higher volatility state.
Speaking of higher volatility states, we've been chatting for a while here. What I think we like to break down quite a bit on the show is skew. And that's something else that you've been including in your research. That's why I like you bringing you on the show, Eric. You're always talking about things that are very topical for us here on the old program. It's gold is one of those products I hold out there a lot for people to watch who are maybe coming to the futures options and maybe they're used to, let's say, a traditional skew of like an index, shall we say, or perhaps even a traditional equity type skew, where they're used to that similar shape, and it doesn't really change much. The slope might adjust a little bit week to week, but the shape never changes. I encourage them to look at some of the commodities, particularly things like gold and things, which can exhibit very widely ranging skews depending on what's going on. Is it a crash? Are people preparing for the upside? You can see a call bid, you can see a put bid, you can see a smile. So gold skew is one of the more interesting ones to watch, particularly for people who maybe aren't used to products that have any sort of vacillation to skew. It'll teach them that maybe they need to be a little bit more adept, and maybe they need to adjust their trading patterns and their options trading accordingly. That said, Eric, what has your research been telling you about gold? Is there an upside bias, downside bias, or are we perhaps more in a kind of a shoulder shrug regime right now?
I would say that we are mainly in a shoulder shrug regime with a slight bias towards upside risk. There is a slight skew in gold to giving a little bit higher prices to the out of the money calls and the out of the money puts. So right now we're trading at around $13.40 an ounce. If you look $200 below that, gold has an implied vol around $11.40 of around 16%. If you look $200 above that, it's around 17%. So it's a pretty mild skew, which I think is interesting because it's my interpretation of how gold is behaving, how the dollar is behaving, how equities and interest rate markets are behaving, that the risks for gold may be more concentrated on the upside than the downside. Now, I could be completely wrong about that, but that's sort of my interpretation.
That's certainly in line with what we're seeing here in the old quick strike. By the way, listeners, you guys can head on over there, cmegroup.com/TWIFO, generate these exact reports for yourself. And looking here at gold, of course, we finished off the week down about 25 handles, so right around a little bit shy of 2%, about 1.8%, about 1330 out there in the near-term futures contracts. Interesting week, OI up about 5%, which is kind of about standard par for the course for all things big gold out here. And in terms of number one with a bullet, it was out here in the well, first off, we talk a lot about these months being kind of concentrated when it comes to liquidity, and in this case, it was fairly concentrated again this week, with the April contract doing about 40, almost 41% of the overall volume out here this week. Weekly is not really getting a lot of shine, a lot of rub this week. And of the number one contracts out here in April, it actually was almost an exact tie in terms of two contracts difference between the April 1300 puts and then also the June 1145 puts. Pretty interesting strike there. We'll start with the April because they actually won by a whopping two contracts, I should say. 5,069 contracts for the 1,300 puts. That should not be surprising. The even numbers, the round number contracts seem to be where a lot of the action is across a lot of our products here. Whenever we're talking, it could be crude, could be indices, could be metals, could be any of the above. People like to aggregate their liquidity around even levels, and we saw that again this week out here in gold. Lion's share of that activity, about half of it coming actually on Thursday, and net about 1,200 contracts opening. So some new opening positioning on the 1,300 strike. Not exactly surprising when we see a sell-off down to the 1,330 level. People are going to be piling into some puts around the 1,300 level. The 1145s, though, a little bit more interesting. Like I mentioned, two contracts difference, 5,067 of these June. Yeah, these were June 1145 puts. Pretty much all of that, 5,067, all of it trading on Wednesday. About nearly 5,000 of that opening. So pretty much all of it opening. So size opening position on the 1145 puts in June, which is perhaps not what you would expect. We saw a sell-off, but perhaps not that pronounced of a sell-off, yet perhaps someone deciding to pile in, or perhaps even deciding to get a little bit of selling some puts out here in all things downside here in precious metals in gold. They're looking for some call action. You'll find it for number 3 on our list. It actually is kind of interesting, even though all the action was spread out across, pretty much concentrated 41% in the front month. The top 5 strikes are actually spread out across 3 different months. It's the first time I think we've seen that in gold in quite some time. Number 3 was actually the 15 half calls out here in September. So A lot of interesting action out here in gold this week with about just a little bit under 5,000, 4,990. So number one, number two, number three, we're all neck and neck out here in gold this week. 15 halves. So you have 1145 puts, 15 half calls. Kind of, again, kind of reflecting what Eric was saying, a little bit of a diversity of opinion out here when it comes to the skew and indeed to the options out here in gold. Total, I said about 5,000, 10 contracts out of that. 2,000 that coming on Wednesday, about 1,700 on Thursday. The rest kind of scattered throughout the week. Actually, net closing, 1,200 contracts net closing on that strike. There's about 12,000 contracts open there. So interesting that someone took the opportunity this week to perhaps come in and take some 15 halves off the table out here, which is interesting stuff out here in September. I'll get to the skew and all that fun stuff. But we just hit on that with Eric. A and B, we have Nick is from his undisclosed location. Looks like they're having some connectivity issues out there. So we'll bring him back in a minute. But while we're doing that, Eric, do you have any last takeaways from our listeners out there in terms of your research on gold before we move on to some of the other product categories that we've been researching of late?
Yeah, absolutely. We do have some really, I think, pretty interesting things to say about agricultural goods options on corn, hard red winter wheat, and soy products. And so what's really, I think, very, very interesting that's going on in those products is that those markets have one of the most incredible skews I have ever seen in any market, at least since just before Brexit, when we had a really strong skew in the British pound options. But basically, those markets believe, or the option traders sort of imply, that the risks are much, much higher to the upside for corn, wheat, and soy than they are to the downside. Even out-of-the-money puts on some of these products are selling more inexpensively, or less expensively, I should say, than at-the-money options, where the out-of-the-money calls are trading at 1.5, almost 2 times the price of the at-the-money calls, depending on how far upward you go. Now, part of that, I think, is explainable just by the fact that prices are very, very low for these products. And when I say low, we're near 10-year, 11-year lows in these products. You really have to go back before 2007 to see lower prices for corn, wheat, and soy than we have today. So I think that there's a perception in the markets that, well, we've been to this terrible bear market and it just can't go any lower. And part of that may be for a fundamental economic reason, which is that there's a belief in the market that a lot of these products are trading at or maybe even below the cost of production. So if prices go a lot further down, there's a lot of farmers, particularly in North America, where costs are relatively high, who risk being put out of business by cheaper competitors in places like Argentina, Brazil, Ukraine, and Russia, depending on the product. So more Argentina and Brazil for corn and soy, and more Russia and Ukraine for wheat. And so this belief that prices can't go too much lower because we're getting kind of below the marginal cost of production in some really, really key growing markets, particularly in the United States, but maybe also in Canada as well, makes it so that the prices just can't go down much further and that the risks are really weighted to the upside. Then lastly, the other factor that might explain that is that you also have the phenomenon of potentially bad weather. So potentially bad weather can always destroy a harvest, of course, which can send prices soaring. And so one of the risks that we're facing in the agricultural goods markets right now is that we have a La Nina going on in the Pacific. So the temperatures around the central and east central equatorial Pacific have become about 1 degree centigrade, or in other words, about 1.8 degrees Fahrenheit cooler than they are normally at this time of year. And so when La Ninas happen, historically has created exceptionally high levels of volatility. So we were talking earlier about how gold is trading at near record low implied volatility. The same thing is true for corn, for soybeans, until recently soy meal, and then also for wheat. I mean, these products have option costs that are kind of all around 15% or below, where historically their realized volatility is closer to around 20 to 23%. And during periods of La Nina, their volatilities often get up to around 27, 28%. And so already with the current La Nina, we've been seeing much warmer, drier conditions than normal in Argentina, which has caused some fear about the soybean crop there. We've seen a big spike in soybean meal prices and implied volatility. But that has not really translated out of soy meal into soybeans or soy oil or into wheat or into corn. The prices have been pretty stable. The at-the-money implied vol is still very, very low. I mean, all of this, though, does concern me. When I look at those very steeply sloped volatility smiles with very expensive call options and very, very cheap put options, it makes me a little bit concerned for one reason. And that one reason is that we have near record high production of all of these products around the world, in large part because production of corn and soy has been soaring in South America. Production of corn has been rising also in the Ukraine. And we also have soaring production of wheat from the Ukraine and Russia. The Black Sea area is producing like never before. And all three of these products not only have very high production, but they also have near record high ending stocks as well. The ending stocks to use ratios are very high, which is a way of sort of adjusting it back to relative to demand. And so the fact of having high production, high inventories makes me concerned that the risks to these products are not only to the upside. The risk may be more skewed to the upside, but there is also downside risk that the market may not be pricing in adequately at this point in time. So I look at that with interest. I think it's very interesting to see such steep curves. With the higher strike prices having such high implied vols compared to the lower strike prices. And we'll just have to see how it plays out. La Nina traditionally has actually been bearish for corn, wheat, and soy prices. If you look over the last 8 La Ninas, which occurred between 1960 and around 2010, 2011, those 8 La Ninas, on average, prices of corn, wheat, and soy fell. The only exception was the most recent one in 2010. What's interesting about that is that previously, most of those other La Ninas happened during periods in which North America, particularly the United States, but also Canada, were the biggest agricultural goods exporters. But over the last couple of decades, South America and the Black Sea region have largely displaced North America as an ags exporter. And La Nina has the opposite effect in South America as it has in North America. North America tends to cause it to get cooler and drier. South America tends to be hotter and sometimes wetter. And it has very little impact at all in the Ukraine or Russia. So these trading relationships caused by La Nina in the past may be changing a great deal in the present. So the fact that La Nina has been bearish for prices might not mean a lot now, but it still causes maybe a little inkling of concern that maybe some of these put options on these products are a little bit cheap.
All right, I think we have him back from his undisclosed location. Mr. Nick, A, are you there? And then B, we've covered a lot of ground here, talking metals and gold skew, but also a little bit of ag skew, which I know a lot of our listeners will be happy about because they're always writing in asking us, what about this ag product or that ag product? So are you there, Sir A? And B, what are your thoughts on the shiny stuff skew and all things ag skew getting a little crazy out there these days?
Can you hear me okay?
Yeah, we got you, sir. Go for it.
All right, so follow up on, I'll skip the gold stuff since I tweeted out a chart for the gold quick skew, so you guys can take a look at that online. But as far as the ag skew, I'll focus on the corn. Eric mentioned that we were on some pretty low levels from a future standpoint. As he knows, as he might have mentioned, I was in and out. We've seen lower prices here when we're looking at the front contract. But ironically, even though the skew is so steep. We've seen steeper in the 2017, the May, June, July, even parts of just starting to come off in August. We saw when calls were richer, even richer than they are to the at the money and to the put. So we saw a pretty wide gap in the quick skew channel, and we're not quite where we were back then. We're around, roughly, if I'm looking at the 30-day count maturity, I'm looking at approximately like 10% rich on the call side and about 7 or 8% cheap on the put side. The front contract in April is following along with that pretty consistently. That's about 28 days expiration. But, we have gone wider, and we did for quite a while, August, September, October, and to the start of November, we saw where we didn't get much tilt back to the put side, but we saw a pretty flat 25 delta skew. So we were trending around zero for the most part. So again, Eric's going to be better with the fundamentals and the practical side of things, just looking at the numbers and the history of things. We've seen wider, so there were probably better opportunities to put that trade on, and we've seen it even tighten up over the last, even the beginning of maybe the middle of January, we saw a little bit tighter in that 25 delta quick skew channel as well. So I tend to think when you see things, again, nothing screams to me that there's a trade there in terms of the levels. But I tend to think when you see something that gets completely racked out like that, you have to start paying attention. Even to Eric's point, where there's the potential for further upside as opposed to the downside, even though with the history of the La Nina cost in a bearish market, I think that when you get to those extremes, it's time to pay attention and potentially look to put something on that's not necessarily a trade that's following the fundamentals, but something that's following the numbers from the volatility histories.
It's interesting. We don't have a chance to. So many products we want to get to, and only have a 1 hour show. We could spend a lot of time on each of those. Really quickly, Eric, before we move on to some other categories like energy and things as well, which I know our listeners rely on us to talk about every week. It's been moving as well. This is the first time we've had you on, of course, since the recent, shall we call it, market turbulence out there in the broad indices. Nick and I have talked about it kind of extensively on recent shows in terms of what's been going on from a skew and from other. Spoiler alert on the skew, it didn't actually change as much as you thought, at least initially. Then we had some initial developments as a result, also from an implied volatility perspective. I was just curious, Eric, it must have been a field day for you guys and the research team over there. Any interesting takeaways or thoughts on the market activity we saw over the past few weeks from a broad index, volatility and skew, and any other perspective?
Well, you definitely threw the skews out for a few days. I guess the markets for a few days were really concerned that we would have this enormous meltdown in equities. And so we went down, we retested the lows, and now we're having this nice bounce at the moment. But what I think is really, really kind of perplexing about this whole situation with stocks is we had this big correction, down 12%. Now we're still trading around 5-6% off of the high that I think we got to around January 25th. And what's really interesting, so we've had this equity correction, but bond yields are higher now, and Fed funds futures are trading at higher interest rates now than they were when that correction began. And not just by a little bit, but bond yields are up by as much as 25 basis points, depending on what part of the curve you're looking at. So normally what happens in an equity correction is it generates a flight to quality that forces the Fed, forces the bond market to stand down. And we have not seen any of that so far. And so I think that this plays into this whole dynamic of the deterioration in the U.S. fiscal situation. That means that our budget deficit in 2017 was around $600 billion. Next year, it's going to be $1.2 trillion. That's just an enormous amount of debt. So it's putting upward pressure on bond yields. At the same time, it's also stimulating economic activity. The tax cuts are going to be really good for economic activity, particularly that drop in the corporate tax rate. Likewise, more spending is also going to generate some additional economic activity as well. So this is not necessarily bad news for corporate earnings. In fact, it's very, very good news for after-tax corporate earnings. So I think that explains this sort of conundrum. At the same time, it's also weakening the dollar. When the budget deficit and the trade deficit expand, normally that weakens the U.S. dollar. And so we've seen the U.S. dollar not being very strong. A weak currency is at once a little bit inflationary. They're not very inflationary, a little bit inflationary, so that's not good for bonds. But at the same time, it's also makes the profits of American corporations that they earn abroad worth more in U.S. dollar terms, and also insulates them from foreign competition from their domestic production. So this has all been really quite good news for the U.S. equity market. But I kind of wonder, how long does this last? How much longer can we see interest rates and equities prices rising together? At some point, somebody in the equity market's going to say, you know what, these stocks are pretty highly valued. I think I might sell some of these stocks and move into fixed income. And I don't know at what level that happens. Does it happen when the Treasury 10-year gets to 3%, or do we have to wait for 30 years to get up to 4%? And it's also going to encourage the Fed to more rapidly hike rates. They had been telling us 3 times. Now there's a little hint of maybe 4 rate hikes this year. If they hike rates 4 times this year, they have rates at nearly 2.5% by this time next year. That could produce a very flat yield curve. And flat yield curves often, as I mentioned earlier, after a period of a year or two, produce explosive increases in volatility. So I think that we may have seen sort of like the first tremor of a coming earthquake, but that coming earthquake is probably not imminent. It's probably maybe a year or 2 off. But this is sort of like the amuse-bouche of what we could see later on.
I like that, the amuse-bouche of explosive potential market volatility. I know, Nick, you and I have obviously talked about a lot about what we've seen out there in the markets of late, and a little bit quieter this week from an index perspective. You mentioned, Eric, the correlation between indices or rates and indices of late. I can't imagine a worse welcome for a new Fed chairman than what we saw just a few weeks ago when he was literally his first day in office, and the entire market just decided to, shall we say, take a break. Maybe a little bit of a signaling to Fed of what the market anticipates from them. But that said, Nick, any thoughts you have on what Eric just broke down for us?
Yeah, I actually have a comment/question for Eric, because that was at least something that I initially was watching when we had the break. We did not see that flight to quality. In particular, we didn't even see it in the short-dated stuff. We were off even in the whites in the Eurodollars, which was really surprising to me, and we were seeing some big moves down there as well. And when you're in the whites, that means when you see big moves in the whites, that means that there's really high interest in the short-term interest rate market. There always is in the Eurodollars, right? It's like a broken record. But when you see movement in the futures like that, it just was a real oddity to me. And I guess my question is, and my comment is, I've never seen that. Usually you see it, you see a flight to quality. And to Eric's point, that was my question is, and you did mention it, but maybe you can elaborate further. I mean, we are losing our status as a flight to quality. We are losing our status as a place of safe haven. That in and of itself is somewhat terrifying. And then given where we are with the yields and the fact that we have continued to see pressure on the Treasury market, it is, and again, I know you can't say you should do this or you should do that, but do you feel like it's a safe entry point at these levels?
A safe entry point into bonds or into stocks?
I would say no. The stocks, I don't think there's any safe entry point at this point into the Treasury market.
Oh, into the Treasury market. Yeah, that's a good question. I think that the Treasury market in price terms has not hit bottom yet, meaning we have not gotten to the top in yields. I think that this has got further to go. My guess would be, just based upon having watched so many equity corrections occur over 3 decades now. I really became interested in this, when I was a teenager, when I saw the October 1987 stock market crash, which was sort of like a gigantic version of what just happened. And so, right now, I think we're kind of having equities trade in a bit of a range. My guess would be we have one last retest of the lows. When that retest happens, I think we're likely to see really, really high trading volumes. And if they fail to break the lows and they start rallying again, and they rally on to new highs with the S&P, say, going over 3,000, that's just got to be super, super bearish for treasuries. You have risky assets rallying, maybe a further tightening of corporate credit versus treasuries. At the same time as you have an expanding economy, maybe a little bit more pickup in wage growth and inflation, although the signs of that are still very, very faint at the moment. I just think it has to be terrible news for treasuries. I think the only thing that could really save treasuries is when this next equity retest of its recent lows happens, which, of course, is not a guarantee, but I think it's more likely to happen than not. If we break through those lows and we start seeing equities moving down in a really, really fast-paced move, then maybe that will cause the flight to quality, in which case you could see a really rapid move upward in prices for a whole variety of fixed income instruments. But the way the equity market's trading right now suggests to me that while the chance of a retest are pretty high, the idea that it's actually going to break down is not certain.
Yeah, it's interesting. Speaking of, since you're talking about the rates in the broad market, I have to ask you about this, Eric. I noticed this when I was looking through some of your recent research. I've seen a lot of interesting and sometimes dubious correlations applied to volatility and to VIX and all kinds of crazy charts and popped up. I only have ever seen a chart like you put out in your recent report. It looks like it was drawn by a 2-year-old, and it's not disparaging to you. Just the chart itself, the lines are just all over the place. Of course, I'm talking about this interesting little bit of research you did about the relationship that you're putting here between VIX and the yield curve. Now, again, I encourage listeners to check it out at the CME Group research page, just because the chart is nuts. It's the only way I could put it. It's all over the place. Eric, really quickly, what did you find from this interesting, maybe slightly disturbing chart? Is there a surprise correlation lurking there?
Yeah, so the thing is, too, I think I love the way you phrased all this. I think it's so great. So, and the particular word you use, I think, is really, really great. Is relationship. Because if you may remember back to mathematics, I think too often when we look at markets, we try to think of one thing as a function of another, and so functions in mathematics, they can't bend back on themselves. They can be straight lines or they can be curves, but they can't come back and loop over some place that they've been to before, because if they do that, then it's no longer a function, it's a relation. And so what this graph shows is a relation between the slope of the yield curve and volatility. And so basically what it does is it keeps moving in this circular counterclockwise pattern over and over and over and over again. This is the third cycle that we have now nearly completed in the last 3 decades. And so how the cycle works is very, very simple. Basically, when you have a very flat yield curve, you wind up and low volatility. The flat yield curve essentially sucks money out of the economy and out of the banking system, and it creates an explosion in volatility. The explosion in volatility usually results eventually in an economic downturn. So as a result, the central bank cuts interest rates. Cutting interest rates steepens the yield curve a great deal. So you wind up for a period with very, very steep yield curves and highly volatile markets. But the steep yield curve re-injects money into the banking system and into the economy, which in turn causes a compression in volatility. so then you find yourself, for a period where you have very low volatility and very low interest rates in a very steep yield curve, which is kind of where we were until the Fed started hiking. And so then lastly, when you go through this very low vol period, eventually the central bank will conclude, the economy is growing, markets are calm, we can start raising rates. And so that's, of course, where we are now. We're sort of midway through a tightening cycle. So we still have like 150 bips of steepness between 3 months and 30 years. That's enough to keep the economy growing. It's probably enough to keep the markets generally calm, notwithstanding the interesting move that we saw in the past month. But I think that it's probably enough to keep the markets generally calm for another 12 months or so. But as the Fed hikes, and as I mentioned earlier, as the Fed keeps hiking, they get that yield curve to flat. Watch out, because the flat yield curve, low vol environment does not last. It always results in some explosion of volatility, whether it was what we saw at the end of the 1980s, whether it was what we saw at the end of the 2000s going into the tech wreck in 2001, or what we saw around 2006 when we had this low vol environment that translated 12 months later into this massive explosion of volatility. As the Fed hikes, they're moving us into very dangerous territory. We have colossal levels of public and private sector debt in the United States. So as they hike, it's eventually going to become unaffordable to service that debt. Also, as they hike, it mechanically expands the government's budget deficit. Every time they hike rates, it causes those T-bills that the government has to issue every 3 months to become more expensive, which increases the deficit. There's a lot of really interesting, really crazy things that could start happening towards the end of this decade, even if 2018, notwithstanding the past month, turns out to be a fairly boring year.
Yeah, so far it's off to the races. I have a hard time picturing a boring year, but then again, you're right. It's only a month or so in. We have a lot more to go here on the show. Speaking of a lot more to go, we don't have a lot more time left on the show, so let's see how much more we could squeeze in. You guys always writing in for different complexes and talk about. You got to be happy today. We're hitting all of the major complexes, and I think we'll close out at least for the analysis portion here on everyone, at least these days, a lot of days, favorite segment outside of indices. Indices have been bubbling up to the surface a lot for a lot of people lately, but energy always out there. WTI, of course, top of mind for a lot of people. Been an interesting week out here in all things crude. Of course, we talked a lot on the show about kind of the ongoing dance, the push-pull between domestic production here and international production, and of course, how that figures out from the supply. Demand is kind of getting caught up in that. We're actually seeing people talking about peak demand all of a sudden, which is interesting. If you remember a few years back, all the conversation was about peak oil. Now it's about will there be peak demand? So that's kind of an interesting flip on the coin out there in all things crude out here of late. We saw the market kind of rallying this week. Crude up about 2 handles, right a little over 3%, despite the fact we saw a pretty bullish report out of the API showing the crude supply out there actually fell. Actually, initially they seemed like they ignored this report. Then, of course, net on the week up about 2 handles. So still working in there. Also some interesting concerns coming out of the shale crowd that the costs are starting to creep up out there again. So maybe at these levels, we had heard for a while a lot of efficiencies have been built into the production process, driving those costs down, at least on the older wells. Now we're starting to see maybe for shale, those costs starting to creep up again. So a lot of that all being factored in to the push-pull we saw out here this week. Net on the week was actually a somewhat quiet week from an overall oil and crude options perspective. OI only up about 2.7%. So usually we see somewhere 4.5 to 5% a week. So it was a wee bit quieter out there. And in terms of where the action was out here this week, it was pretty much almost half, 48.6% coming in that April contract, which is, of course, the front month contract. The weeklies, once again, getting no love out there this week. Number one with the bullets. The 60 put, kind of getting back to what we were saying earlier. Liquidity loves these even strike levels, and we saw that again this week in crude. 60 put doing about 18, almost 19,000 contracts. The lion's share coming on Thursday, about 9,500. Net on the week, actually, a lot of back and forth on the strike, which is, again, not surprising given some of the action we saw this week. Only about net 2,000 opening on this strike, so a lot of back and forth. Again, even numbered put strike, getting a lot of back and forth action on this week. Not exactly super surprising. Number 2, hot on his heels, was the calls. So interesting as well. The 65 strike, number 2, 17, almost 18,000 contracts going there. So pretty close, neck and neck. Thursday and Tuesday kind of tied, about 6,500 to 6,800. Very close there on Thursday and Tuesday, both days. Again, net slightly closing here, about 2,000 and change. So we saw a little bit of interesting activity on that very tight strangle / risk reversal in the front month, 60, 60, 65 strangle out there. Also saw some action in the 58 puts as well, about 15,500 of those lighting it up. The lion's share, about a third coming on Wednesday, about 5,300 contracts. Net more opening out there, about 4,500 net opening on that strike. So a little bit more positioning, a little bit farther south there on the old strike chain. Just really quickly before I toss over to Mr. Nick in his undisclosed location, trying to see if I see any interesting esoteric strikes that were lighting it up this week. The crude bulls, if you're one of those, you like maybe a little bit longer term upside towards the end of the year. We saw someone piling into the D80s this week on Thursday, about 3,400 going up. Total of about 4,000 on the week. It's actually net closing a little bit, about 600 contracts on the week. So someone perhaps after a little bit of back and forth deciding to wind down a little bit of some positions on the 80 strike. So take that for what you will there, crude bulls. Also saw farther out there, June 2019, the 80 strike getting popular again, about 5,100 going up, 4,100 of that going up on Thursday, 1,000 on Wednesday. Net about 3,000 contracts opening there as well. So a lot of interesting stuff going on out there. Mr. Nick, I know, actually, before we wrote out really quickly, we did see some action in the D's 2019 90s as well for all you crude bulls. Just about 2,000 going up this week. And actually only about half of that, about a little bit under 800 opening. So about 1,800, about 800 opening. So interesting paper kind of across the board. Mr. Nick, anything catching your eye out there in crude land this week, sir?
Well, I'm trying to pull it up now because I was looking at the Tweo report, but I wanted to take a look and see just how these current vol curves are relating to each other, right? We talked a little bit about this. The other day in terms of how the at-the-money volatility, we're seeing a change in at-the-money volatility, but we're not seeing too much of a change in the shape of the curve, and that was just sort of the at-the-money moving along the current vol curve. So this week, we're seeing the same thing, right? Because we're coming off a higher vol on the downside, moving back towards where we were a couple weeks ago in terms of the price range. But vol did come in on top of that change in location on the vol curve itself. So that was one thing I really wanted to take a look at while we were chatting about it. As far as I popped open the long. If you look at when you look at the historical volatility, and again, we tend to talk about the 30-day vol. When you look at it over a short period of time, the volatility doesn't look like it's obviously not as low as it's been because with the last sets of movements that we have up and down, we saw a little bit of an increase in volatility. But if you look at that historical volatility over a 2-year chart, it's just kind of a little bit of a blip up on what's continued to be an overall downward trend in that volatility. So, again, we talk about it all the time in the show where we have movement, whether it be significant or not, but if it's movement within a range. Today, when I looked at it, we saw the EIA come out with the lower stockpiles. We saw that immediate jump in the prices, but we didn't see any change in volatility. We didn't see any change in volatility for the most part, is because we are just kind of going back within this higher end of the range that we traded. Now, so that's always interesting, right? We kind of just reset our range. Before it was at a lower place, now we're at a higher place. So the more I watched it, and again, I'm always coming from the perspective of a retired trader more than anything else, but it just seems like any chance you get to unload volatility when it happens to be higher, within reason, if there's going to be an opportunity to buy it back. My boss used to tell me that when I was on the floor at O'Connor. It was better to be short than it was to be long, but it just seems to be taking care of itself here, where you can make money, getting in on these spikes of volatility and selling them, and then waiting for the market to settle down to recover. Now, with that said, given all the movement, and here's sort of the other side of the coin, given all the movement we've seen in these markets, and the movement we've seen within these ranges, and significant movement within these ranges, 2, 3, 4, 5%. You also have an argument in these low volatility markets, or these increased little bit of volatility markets, to own volatility, because again, it's not necessarily what you're looking at from purchasing a vol standpoint, but purchasing of the gamma, right? So I'm starting to like these rangy markets because people complain about the volatility side is so low, but this low volatility has other opportunities. You're paying attention to the range and sort of watching what you can do from a gamma scalping standpoint, and also seeing what those volatilities look like historically. So that's not really noticing anything other than making some observations. The skew, if we're looking at the 20 and the 52-day, 53-day contracts, we didn't see too much of a change in the shape. We saw a little bit cheaper puts in the May contract, a little bit cheaper in the April, and the calls kind of generally flat to the at the money. So, and I think that's got something to do with the fact that we've sort of seen those prices on the upside already, so there's not much interest. So, again, same as always, we sort of reestablish ourselves in the range. I don't see too much interesting going on from a volatility standpoint, even if we get these 2, 3, or 4% moves, right? Mark, you and I talk about getting a 2% move on top of a 2% move, but this week we had a 3 and 4% move across the term structure and didn't really generate much interest. So I guess we're back to the wait and see, watch the range in the crude, at least for now.
All right, speaking of watching, we got to watch and see what you guys have on your mind for a really quick version of the futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, we're up against it. We've been talking a lot about different products. Maybe we'll run a little bit late today because it is, I don't want to keep Eric too long because he has to go to sleep. It's late over there in London. But really quickly, we asked you guys earlier this week. We'd like to ask you guys questions too. People are spooked about the market. Hedges are flying left and right. The question remains, how are you guys hedging your portfolio right now? Are you choosing the traditional non-options route? So going into the metals, could be gold, silver, pick your poison. Someone wrote in for palladium, I think. Are you choosing a volatility product, maybe a VIX Calls or one of the ETPs out there? Are you choosing the more traditional path of index puts, or maybe an S&P put, or maybe NASDAQ, depending on which index you're looking at? Or are you going the more, shall we say, non-traditional route of the crypto and the Bitcoin and all that fun stuff? Eric, I'll give you pride of place here. What do you think our audience is voting for here, sir? Is it the metals? Is it a volatility type hedge? Is it a straight up index hedge, or something along the crypto lines?
That's a good question. I think that as an economist, I think that the best answer is probably a diversified portfolio, because you don't really know what's going to happen in the future. So having some fixed income, equity, gold and silver, and maybe a little tiny dash of cryptocurrency might not be a bad idea. But you probably want a volatility weight. So since the cryptos are pretty volatile, they should probably be a pretty small weight if you hold them at all. I think from my own perspective, I like gold and silver a lot as portfolio diversifiers. I think that they have a lot of upside potential. I'm not sure rates have hit bottom. I think equities are looking pricey. it's still hard to find a good alternative to equities, especially outside of the U.S. I know this is really hard to believe, but U.S. rates are actually the high-yielding bonds around the world. If you compare them to bunds or gilts or French OATs or Japanese JGBs or even Canadian and Australian bonds, U.S. actually has the most attractive rates. So if there is a massive flight to quality, treasuries will benefit probably more than any other bond anywhere else in the world.
Spoken like a true economist, a diversified portfolio. I couldn't have asked for a more on-script answer from you, sir. Well done. I also figured you might like the metals. That's why we threw that in there for you. Mr. Nick, are you going to go uncorrelated like crypto? What do you think our audience is feeling these days, sir?
Well, I kind of know what I'm doing, but I'll leave that for my own personal thoughts. But I would guess, given that we saw the skew come in the index puts last week after the big spike, right? We saw a big change in that fall curve. I would say that they're probably taking a deep breath and patting their brow, given the opportunity to get some puts on again while they come back to a reasonable price. I would go with the equity puts, straight up equity puts.
Yeah, we are speaking to the choir a little bit here on the old Options Insider Radio Network. People who listen to us tend to like their options, so direct equity hedge, kind of hard to argue with that. And that's pretty much what's leading right now with about a day or so left in the poll. 34%, was just slightly over a third, saying straight up index puts. Hard to argue with that. Number two, actually, out there in the crypto land, Bitcoin, which is interesting. I think we've all seen kind of how actually correlated, surprisingly correlated it has been on the big market sell-off. What did crypto do? It led the sell-off almost in many ways. So not exactly what you want to rely on for your hedge. 21% saying some sort of volatility product, maybe a VIX call or something else like that. And 19%, only 19%, Eric, going for your traditional diversification of the metals, gold and silver. So our audience, shall we say, embracing the new techniques. So we got time for a couple of really quick comments or questions here. We got a bunch of them. Keep them coming, listeners. We had a lot of content on the show today, so we didn't have time for too many questions. Scott Somer writing in with a question we touched on last week. This was someone asking about inverse commodity volatility products. Asked us last week. He wrote in to say, yeah, there are two. One on WTI, which is DWT, and which is has an ADV of 4.4 million shares, and the other on Brent, ticker symbol DBRT, which has an ADV of 600 shares. Both are triple bear. Good suggestion, Scott, but the question was actually inverse volatility ETPs, not just inverse. So I'm with you on the inverse. There are a few inverse products out there. In terms of inverse volatility, I'm not aware of any. And maybe after the events of the last couple of weeks, there probably aren't people rushing out there to list new ones. He also tries to sneak in a question here. Usually I won't allow that, but I'll be really nice. Usually it's one question, but he kind of only commented. He didn't question. He also asks which products are closest to their 52-week highs in terms of implied volatility. I don't know, Nick, this falls into the homework category. I don't know. Do you want to do some homework for next week's show, Nick, and research which products are closest to their 52-week highs in implied volatility?
I think I saw that question, and I think what we need to do is we do have a tool out on the CME website where you can go and look. Well, I think it's on CME Live, where you can go out and look and see what has done what over a period of time. And I think we'll have to just make one of those links a standard. What's the highs and the lows. We have things that have changed the most over a period of time, but we don't have 52-week highs, 52-week lows. So I guess you can project that, but it's not quite as easy to see from the chart that you got created. So yeah, I'm willing to do that homework because I think it's beneficial for more than just one person.
Look at that. Nick volunteering to do some homework for you. Scott, you must have hit a nerve. But yes, we love your questions. Keep them coming. We'll get to more soon, I promise. If you don't get them on the show, we'll try to filter them out. We respond to everybody directly, even if we don't get a chance to get to them on the show. But that music means we're past our time, listeners. We kept you late, but we were having a lot of fun. But before we go, let's go back around the horn. We'll start with you, Eric. Before you get to go night-night over there in London, what you guys are always working on, interesting new research. What can we expect from you guys over there at the CME Research Group in the coming months? Maybe any crypto on the horizon?
Maybe we might put out another paper on it, but I think that in the very near term, starting out early next week, we should have I think a pretty fascinating paper about how soybean oil consistently forecasts what's going to happen with WTI crude, which is the weirdest paper ever, but it should be a pretty fun one for both traditional futures traders as well as for options traders. It has some good option information on the skew of soybean oil versus WTI, which is kind of an interesting potential box to look at. And then beyond that, we have some really fun research coming out on an alternative measure of China's GDP that actually does a great job of forecasting movements in commodity prices as well as commodity currencies like Aussie, Canada, the ruble, the real, other currencies like that. And we also, lastly, will have probably a paper coming out on the relationship between the yield curve and Treasury option volatility. Treasury options are a fascinating market, as are Euro-dollar options, as I'm sure you know, and all of those can be influenced in much the same manner as the VIX and equity volatility by movements in the yield curve.
There you go. Check out Eric and his team, Blue and the rest, cranking out great research, very topical stuff. Head on over to cmegroup.com, click on the research tab. It's out there. I got a feeling it just shows how crazy the markets have been of late, Eric. We didn't even get a chance to talk really crypto on the show, which has been dominating the conversations. If nothing else, this recent market sell-off has been nice to kind of refresh the subject matter. People aren't hitting us up 24/7 about crypto all the time. Now it's only maybe 23.5, 5. So it's a little bit of a break from all things crypto. That said, Mr. Nick, when you get back from your undisclosed location, sir, what can we expect coming down the pike from you and the crew over there at Quick Strike?
Let's see. So there's nothing special coming out this weekend, but I think next week you'll be able to find the new tool that CME is going to be releasing called the Strategy Simulator. So you'll be able to build intra-month spreads and then play with them and see how they react to different market conditions. So that's going to be a fairly popular tool, I think. And then over the course of the next week or so, you'll be seeing more and more tools get integrated into the CME Group website. So we'll have some easy ways for you to get access to expiration calendars and the information from those calendars, where those dates fall in relation to the economic numbers that are coming out. So we're trying to do a lot of sort of very practical, useful tools for the users. And then there'll be in the very near horizon an embedded options calculator specifically targeted towards the CME Group products, but it will let you do some really fast and efficient pricing directly on the website. Probably going to be, I think, one of the nicer calculators that are available out there.
Check it out over there at Quick Strike, or just go to bantix.com. That's BANTAX, TIX, I should say, easy for me to say, .com, and then click on the sign up for Quick Strike link there. You get all that good stuff we talk about here on the show and a lot more. You get the skew, you get the vol breakdowns, you get the open interest changes, you get the unusual activity, all the fun stuff, the charts, the graphs. You click on the TWIO report in the program if you want to see exactly what Nick and I are looking at every week. That's the program actually, and the report actually done for this show, or the TWIFO report is called in there as well. It used to be TWIO, now it's TWIFO. We've updated it there. So check it out, bantix.com, to learn more. And on behalf of Eric and Nick, and indeed myself, I thank all of you out there for downloading, streaming, and subscribing, and for sending in your thoughts and comments. Looking at some of them right now, they're hilarious. We love them. Keep them coming. And we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.